The big risk, in at least my opinion, is the uninversion of the yield curve. And we talked about this a few months ago, but now we're at a point where, we all know that if we put money away for longer, like, going with a parent to the bank, looking at CDs, you're supposed to get more on a 1-year CD than you do on a 3-month CD. You're supposed to get more interest, right? Well, the yield curve was upside down for so long where, from a bond perspective, you got more near term and less from a long-term perspective just because the Fed had raised rates so quickly. Now you're at a point where it's uninverting, and now things are normalizing, right? But it's just like the mortgage rates side of things that we talked about a few months ago as well. The 10-year is going to affect things in the economy. It's going to affect higher mortgages, which would affect a higher 10-year would affect a higher mortgage, which might affect the real estate market, right? Likewise, a higher 10-year would also affect what people are willing to pay for stocks, and that could affect the price of stocks also. So this chart that we have on screen, the yellow line represents 0, where the curve is just flat between a 10-year and a 3-month bond. You can see it was negative down to negative 2% back in 2022. Now it's positive again. The long run average is 1.1%. But if we put a measurement on the chart and looked at where kind of a sweet spot would be historically, going back from like 1990 until now, it would be around 2.2% higher. That would imply, I don't think we're going to get to that point, but if you've got a 4.3 90-day treasury, it would imply that the 10-year could go to 5.4. It's currently at, 4.6? 4.6, 4.7. It could go to 5.4. That would be the long-run average. No one should be surprised by that.
No one should be surprised. But to your point, that probably re-rates stocks a little bit.
It would re-rate stocks.
So
there's no question.
Yeah.